We're seeing inflation surge across many parts of the world to multi-decade highs. Consumer Price Index in the US is running at around 7.5% and 5.5% here in the UK. Now, there are a number of driving factors that are behind the high inflation numbers we're seeing at the moment. Firstly, it's the cost of energy, and particularly gas prices. In part because of reduced supplies from a very cold winter last year, and also lower supply from wind energy. But it's also in part because of strong demand for natural gas from some large Asian economies. More generally though, shortages and production bottlenecks have had an impact on company supply chains, which has driven prices higher. The shortage in semiconductor chips is a really good example. You've seen that have a significant impact across many different industries, most notably automotive production, which has pushed up the price of both new and used cars. But more broadly speaking, lockdowns and more recently the zero COVID policies followed by some manufacturing countries has impacted exports, while demand for those goods remains high, and that has impacted prices. And then pivoting to the demand side, we've also seen demand for goods and services recover very strongly from the pandemic lows. And it's been helped by the enormous fiscal and monetary response that we've seen to the pandemic. In the UK, excess savings are sitting at just over 10.5% of annual disposable income. In the US, that number's running around 15% of disposable income, well above pre-pandemic levels. And with demand recovering strongly and supply somewhat constrained, prices are being impacted. The final component is labor markets. 2022 is set to be another year of extremely tight labor markets. There's this tremendous mismatch at the moment. In the US, the gap between demand and supply of workers, it's now at the lowest level that it's been since 2001. Companies are desperate to find people, and its effect is noticeable through higher wage increases. Well, we've already seen a big change from central banks, pivoting rapidly over the past couple of months as inflation's begun to climb. Inflation has become the number one concern for both investors and policymakers, and central bankers have made a clear shift towards a more hawkish stance on inflation. Now, emerging economies and a few developed ones, the UK in particular, have already begun implementing interest rate hikes. But we're now seeing central banks collectively swinging to action, shrinking their balance sheets and embarking or expected to embark on a series of rate hikes that will be faster and more aggressive than was expected a few months ago. Inflation is something that's going to be with us for some time, and certainly at more elevated levels than prior to the pandemic. And so controlling inflation looks to be the central bank's biggest challenge in 2022 and beyond. Firstly, we think 2022 is going to be a new environment for investors, and it's going to be a very different environment from the past decade, where we enjoyed structurally low inflation and low interest rates. Inflation and the policymakers' response to inflation will drive that change. Now, what the chart on the screen shows us is that the different segments of the equity market and different sectors within fixed income have a tendency to perform very differently as we move into an environment of higher inflation and higher interest rates. Within equities, we see a likely dramatic shift in the fortunes of growth and technology stocks that have performed so strongly over the past decade, while equity market returns overall are also likely to be more muted in an environment of higher inflation. Similarly, the areas of the fixed income market that have performed so well over the past decade, government bonds and high-grade corporate bonds, are likely to be challenged in this environment that we think that we're moving into. Our concern is that some of the solutions that we see in the market aren't geared to having much inflation sensitivity in them at all. And a good example is that almost universal basic 60-40 portfolio. It has a large allocation to nominal bonds, which, as we saw in that previous chart, tend to do well in a deflationary environment. And it has an even larger allocation to equities, which almost have this love-hate relationship with inflation. Broadly speaking, equities tend to do well when markets transition out of a deflationary or disinflationary environment. But sustained inflation could be a worry as profit margins are generally squeezed and valuations come under pressure. We also expect that market cap weighted benchmarks that have high exposure to tech and growth could face headwinds as rates rise. Growth companies, almost by their very nature, derive more of their value from earnings that are much further into the future. And so rising rates has a larger impact on the present value of those future earnings, making these sorts of companies more vulnerable to this new environment. And so investors need to take a look at how they invested today, what their inflation sensitivity is. If you're taking a bet on the direction of inflation, and I think in the case of that simple 60-40 portfolio, you're betting that inflation is going to decline, we would urge investors to consider adding exposure to diversifying assets to mitigate their inflation risk. Now, we take an all-weather approach to constructing portfolios. And what I mean by this is we want exposure to a number of different asset classes and sub-asset classes, each of which are known to work well in different economic environments. And really, this means that SEI strategic portfolios already have allocation towards asset classes that are better suited to an inflationary and a higher rate environment. And as timing a change in the economic environment is incredibly difficult to do consistently, we think investors should demand that level of diversification in their portfolios from the outset. Now, in our portfolios, we have allocation to equities and fixed income, but we've also got exposure to inflation-sensitive assets and alternatives, asset classes that are typically better suited to an environment of rising inflation. Secondly, we take a total portfolio approach to building our solutions, which leads to the portfolios being constructed holistically, looking at the specific characteristics of different asset classes and sub-asset classes in relation to one another, but also the underlying objective of the fund. And so our approach leads to greater diversification across our range of solutions. Now, within equities, we have the typical regional exposures, but we also have positions in smaller companies and emerging markets. Within fixed income, as we touched on earlier, we don't have this over-dependence on ordinary government bonds. We typically diversify in this component of our portfolios to include the likes of short-duration fixed income, high-yield corporate bonds, and emerging market debt. They're all asset classes we expect to perform better than normal bonds in a rising rate or rising inflation environment. And those are the asset classes that we think you should be adding to your portfolio if you don't have exposure at this stage. And finally, as an active manager, we believe that the change in the economic environment generates opportunities that we're able to capitalize on by having, say, larger allocations to those investment approaches or styles that are best suited to this new environment, as well as overweight to asset classes such as commodities that are likely to perform well in this reflationary environment. So by way of an example, within equities, we are underweight expensive large cap tech and high growth names, and have a higher allocation to value-orientated managers, which really tend to perform better in a rising rate and rising inflationary environment.